Hello, Warriors. How's everyone doing today? I'm Dale Pinkert, the host of Face, and there's my face. I'm only 25 years old. Trading can age you a little bit. How are you? Shahab, Mark, Gerald, everybody. I want to welcome all our viewers from investing.com. And that's enough of this. Let's talk markets. Hi, Bren, Kevin. Okay, so I wanted to start off with gold. So you guys know I've been bearish. Turnaround Tuesday trade was to short gold and silver. That happened to be up here. And, you know, we've had a big break here and people are going, well, I wonder why gold's breaking. Dollar was weak up until today. In fact, the dollar is bouncing and gold's bouncing. So the relationship, I remember a lot of gold bulls saying, God, you know, gold is doing great with a firm dollar. Can you imagine how strong and what kind of jet fuel it'll have when the dollar finally weakens? Well, here's their answer. The dollar's been weakening with gold, and perhaps it's because there's another alternative to gold, you know, with the dollar under some pressure. There's other hedges against the dollar besides just precious metals. So you just want to take a look at a couple of macro, and I'll show you why. So, you know, we held where we had to. If you're bullish, this was the old triangle line that we were looking for this breakout, and that it was going to be a terminal thrust. So we had the first break, and then this looks like a failing rally. Booyah to you too, Kramer. So there's your daily look. Since we're almost at Friday, why don't we take a look at the weekly? Pretty ugly candle. It is a 2-week reversal as long as by Friday we close under 1734 and back under these lows of 1685. I think for sure you could see 1650. Well, nothing's for sure. Actually, I'm kind of looking at this. It's going to be the weekly uptrend around 1550. You know, it could be a great place if you're, you know, bullish gold to add to your gold holdings down here. So that's what I'm thinking. And what's the reason? And you know, let me coach you. So, you know, I've been in TBT, which is a bearish call on bonds. And we've been doing this. And actually, you know, with all the, you know, everyone looking for one more wave to the upside in the bonds, and you're fighting the Fed and all of that. When the market is just, say you're in a position and it's not happening, your directional bet, but it's not bearing you either. It's just taking a long time. I've been doing this a little while. It might be worth writing this down. Might keep you a little persistent, because you know how many attempts you have to make sometimes to be there on the right side of the market. The markets will try to wear you out until when you're finally worn out, it happens. So, you know, one of the most important things about trading is persistence, because there's going to be all kinds of things. Things always take longer, at least for me, than I think they're going to take. And so look at this. Looks like we had a breakdown in TLT, which is the 20-year treasury. And then even look at the 10-year note. I think it had to do with the ADP report. But to me, it looks like yields are going to try. Now, you know, everything could change in a heartbeat in a New York minute on the NFP tomorrow. And I think it went up because the ADP numbers weren't as bad. But I thought yield should be rising just based upon the recovery in the stock market, right? So I think the surprise and the most crowded trade on the planet are people that own debt. They feel they're safe from the stock market. There's that. So there's more of it. The only bigger market than the global bond market, I'm talking, not just sovereigns, but high grade and junk and everything, it really dwarfs the stock market. So I think there are more people stuck long bonds, especially after we had this, something I've never seen in my whole career. I'll use TLT, was this during the crash in March. This. So you had the blow off and then a bond crash where all the markets had seized up and Fed came in and unlocked the markets. Okay, so it could be we're getting a rollover here. Maybe we're going to test this, but why not, down to 150. So anyway, if yields head up, that's creates an opportunity cost for gold that could last for a little while. At least that's how the reporters will explain the sell-off in gold. The people have started going, well, yields went up, but we'll see tomorrow. So I don't know what song you're talking about, Nokia. So Dixie, a lot of people have targets down here around 95.60. This was a pretty easy trade. And I have to admit, I was selling the dollar up here, but then down here, I listened to some people and I thought we were going to have a turn in the S&Ps, and I didn't want to be caught short the dollar. So I've missed most of this week from 98.10. Maybe we're headed here. So I know a lot of people think we're going to hold in here and then head up. Now listen, if you think I'm a bear, you're going to want to stick around for our interview at the top of the hour. And one of the biggest bears I know is Henrik Zeberg. Oh, Don Henley. Yeah, great. New York Minute. Yeah, Don Henley. It's a great song. And it's true in life and in trading. So it's going to be an interesting interview because Henrik's taken a lot of heat for being, bearish everything, including gold. And we had this huge rally in gold. And, sometimes I know all of us are wrong about things, but I have some questions to ask him about opportunity cost. And when I have a bias, I tend to lose money if I'm wrong about the major trend. Every once in a while, I'll make money in a reaction, but if I'm coming in and fading the trend and the trend is overwhelming, that's what happened in gold. So I'll be interested in his thinking about missing a major event, even if there's another one to come. So stick around for that. Want to invite everyone to become part of us, part of our community, where you get pips, pattern and plays that are pushed out on your mobile app or tablet. I went to the University of Hard Knocks. Anyone else attend there? I have a BS in survival skills, like the Navy SEALs. Okay, anyway, so I'd like you guys to consider joining us. You could check the trial out. I think we have the best combination of research on the net, because normally when you subscribe to a service, they really have one methodology and it's all one tune, one note Charlie, where we have Grega with Elliot and Andre with harmonics and Blake with basic technical with Steve Volge, and one of the best macro guys out there is Stelios. And there's no policy that we have to, our analysts and traders have to agree on the same thing. So they're also not just an Elliott Wave practitioner. Grega, when I was with FX Street, they have awards every year. And by the way, ForexAnalytix won one last year for being best new service. So Grega is always an award winner there. Okay, so you get the whole team's looks and charts and views and takeaways and the man hours for doing this kind of research, covering this many instruments. You'd probably have to have a staff. And when you become a member, we're your staff. We're doing our work. There's no pressure for you ever to take our counsel or act on what we're seeing, but it could be a great sounding board for you. I'm a big believer in collaboration and surrounding myself with traders that are better than me, and then you rise to that level. So just want to invite maybe Joe, put up a link. And you know what? It's Discount Thursday because we have everyone here. Hang on, Martin. So if you're interested in a semi-annual or annual subscription, get a hold of Joe Perry, and he's probably going to have a very good offer for you. So Joe, if you could post. And with that being said, bringing on one of the founders of our company, Blake Morel. Blake's, his reputation precedes him. How are you, bro? Are you with me?
I am. Good morning.
I put him to, I thought maybe I put you back
Can
to
you hear me?
sleep. Yeah, got you.
Looks like somebody had a question on the Aussie, right?
Yeah, go ahead.
Yeah. So, well, first of all, good morning, everybody. The ECB just came out, and before I go over the Aussie, the Euro, they announced the PEPP program, and they announced 600 billion, which the market was thinking 500 billion. So that extra, and what's the word I'm looking?
Juice.
Stimulus.
Yeah.
The extra amount. It helped propel the euro higher, and this is something that I think we talked about it yesterday.
You said be careful with the ECB, if you were going to short it, and
well,
that was good advice.
The fact of the matter is the more the stimulus, the stronger it's going to make the currency, and that's something that we talked about on the daily roundup. Now, in the daily roundup, you have to be a ForexAnalytix subscriber to listen into that, but the thing is the euro actually strengthened a little bit. We broke into new highs, but we are challenging some pretty key resistance. This is the 127% extension. So be a little careful with the pair up at these levels. I think the risk is that we could, start to turn lower, especially if you're looking at the stock market. The stock market is actually starting to weaken. So the way I'd play that is not necessarily the euro dollar per se. I'd play it in like the euro Aussie or euro New Zealand on the long side. This would be the preferred way to play any type of risk off, because what's happening here is that you have the euro that's probably going to stay relatively well bid all day, but then you could have some of these commodity currencies that come under pressure. And I think that's entirely possible. So that's how I would consider playing, this quote unquote risk off if we see it. Not necessarily, because typically you would say, oh, well, I'll buy the dollar, but, but I don't know if that's the right play against the euro, not during an ECB day. Maybe the better play is, trading, some of these other currencies to the downside, like, the cable just sold off. Cable just came off of its highs. The Aussie dollar, Martin just asked about the Aussie. Look, I think the Aussie is pretty overbought here against most currencies. So do I think it's a full-on reversal of the Aussie? No, not yet. But I do think that if you're long, you got to be a little careful, and a drop back towards this uptrend line and this previous resistance should act as current support. That comes all the way back down at 60. Let's just call it 67 cents. So we have a couple hundred pips to come down if it's really going to start to come down. So that's something that you have to take into consideration for for the Aussie, I think, because I do think that the Aussie is trading in a pretty overbought situation. I was looking at the, not just the Aussie against, the dollar, but, you look at the Aussie New Zealand, we just had a false breakout on the upside. You take the Aussie, let's take the Euro Aussie. Euro Aussie just sold off pretty aggressively and just hit some pretty key support. This is the previous channel support, and we're bouncing. You can see that, the spinning top yesterday, but really starting to gain some momentum. The Euro New Zealand off the 200-day moving average, and we're trading near our highs of the session. If we trade back up above 176, which is 100 pips away from where we're currently at, but that would be a false breakdown. So, and then one that I'm in particular that I'm short is the Aussie Canadian. And I'll tell you the reason why is we hit a 618 retracement and a 50% weekly retracement at the 94.20 level. So I'm, keeping a short. Oops, sorry, let me turn this down here. Hold on. Oh, wow. So the guy from my office was just talking about, we got to watch the dollar Mexican peso. He wasn't talking to me. He was talking to somebody else in the office. But he was just saying that the Mexico City hospitals are at 80% capacity right now. I do think that COVID-19 is going to be a very big problem for Latin America. It obviously is in Brazil right now, but Mexico is another issue, which is, that's, when you have a healthcare system that is on the brink. So you got to watch the dollar Mexican peso, especially a break above the 22 level. Break above 22 would cause a massive squeeze higher for the dollar Mex. This was a big breakdown point. Because this is the breakout point. It was a big breakdown point. Remember, it stalled there all week last week, and I was playing the dollar Mexican peso on the long side for the bounce right here, and it was great. I just kept, chipping away and making some money as it was bouncing. But then it broke down on Monday, and but we did hit the 618 retracement. You can see this fib level right here. That's from where the move started. So it's the 618 retracement. If you look at the two candles from, yesterday was a hammer, long lower shadow doji, and then the day before was like a little bit of a pin bar. So yeah, you watch the dollar Mexican peso, we get above 21, 22. Exchange rate, it's probably going to rally substantially. That would also coincide with some risk off. So just keep that in mind as you're trading if you're trading the US dollar Mexican peso, just keep in mind that it would have to coincide with some risk off to really get it higher. But it is something that I think we need to be paying attention to. I just bought some literally at I bought some at 2174 earlier. So I mean, I'm up, I don't know, however many pips that is right now, but it's had a nice rally. But I'm really looking for a move above the move above 22. Move above 22 is where things are going to squeeze a little bit higher. What else did I want to talk about really quick this morning? Oh, the dollar yen. I by the way, I still love the dollar yen. I'm been trying to buy, and I actually have a bid now to buy the dollar yen. Near like some of these supports that you see down here. So you can see the 38% retracement right now. If we drop from current levels, would be at 108.36. 50% retracement would be at 108.12, which would be near the breakout point. Those levels are possible. Those levels are possible, especially going into tomorrow with the non-farm payroll. I mean, if the non-farm payroll comes out and it's a little weaker than expected, the dollar yen is going to drop back down towards the 108.10, 108.20 level. And frankly, I'm just looking to buy it down there if we can, add some more down there if I can get it. But I can't chase it up here either, especially with the, relative strength has been diverging intraday. It's like I just can't buy it here. I want to buy more. I just want to buy it at a little bit cheaper price, trying to get it down, down at these levels. But the dollar yen is something that I'm keeping a very close eye on. So here goes the euro. Just watch the euro at the possible false breakdown. I picked up some dollar Canadian. For those of you guys in the chat room, I'm going to let you know right now, I'm going to move my stops to break even. I actually bought the dollar Canadian at 134.60. My fill was 134.68 and change. And I mean, I literally bottom ticked it. I had my order at 62, and everybody who's ever is in our chat room, they already know that I picked it up down there. Here, if you guys want to see what our chat room looks like, let me go back a little bit. Long dollar Canadian 134.68. I mean, I literally adjusted my order from 62 to 68, and I got a fill on JP Morgan, and I don't know how I got that fill, but it was literally the bottom tick. And I'm going to move my stops to break even now, so there's no reason to risk it from here. Just want to let you guys know. You can see all the chatting that goes on just over the last couple hours. Anyway, guys, gals, I'm going to bring in Steve and Stelios. Good morning, guys.
Hey, somebody's lazy today.
I'm not lazy. I'm just bringing you in for some opinions here. What's going on? What do you feel about the ECB?
He pretended he had problems yesterday. He's lazy today.
Yes, I know. I can see the trend, Stelio. I can see the trend.
No, I seriously, like, my router went out yesterday. It was a disaster. I was so irritated.
You know something, Blake? I totally get it because my dog ate my homework today.
Okay, whatever. No, but seriously, I have this. I have a what do they call those? Like a cable feed into my house. And so the router is a little different. The router is not like your normal router, and so I don't have to reset it all the time. But man, when it goes on the fritz, it goes on the fritz, and so yesterday was one of those things. My trade station died. I was triggered into the dollar Mexican peso at 21.62, like for a pretty substantial amount, and I'm like, oh my god, I just lost my trade station. I had to go to mobile. I lost you guys. I was trying to restart the route. It was a disaster. I'm just, it really was. So anyway, look at this dollar Mexican peso. What a pickup. I really am glad I picked that up. I'm going to actually take profits off of that right now, because I'm not saying that it can't go higher. I just want to see it above 22 before I get really bullish. That was a really big move from 73 to, well, here we are at 93 right now. So
you'll never go broke taking profits, Blake.
No, you won't. And it sure does save a lot of frustrations along the way. Sometimes you can be a little irritated when you take profits and go, whoa, I should have.
Woulda, coulda, should have landed.
Yeah, you get into that situation, but whatever. I do. Yeah, it happens.
Yeah.
So what do you guys think about this PEPP? What do you guys
First of all, I think they should rename it to PPT. Plans Protection Team.
Yeah.
Wait.
Just
to call it what?
Side. I think they should rename it to PPT, Plans Protection Team. Although that's trademarked. So they have to agree with the Fed first.
Yeah. Well, what do you think about the idea, like, in what we just saw, which made sense to me, but I know it's not conventional wisdom. And matter of fact, last night I was talking to Chris Weston over at Pepperstone Securities, and he's in Melbourne, Australia, and I'm obviously here in Phoenix, Arizona. I was talking to him last night because it was Thursday morning there. It was Wednesday night here. and we were just discussing, some market stuff, and I said, look, and we were talking about today. I said, look, if they increase their PEPP by more than the market expects, the euro is going to go higher, not lower, because the more liquidity you provide your economy right now, the better it's going to be for your economy. And he goes, I couldn't agree more. And that's the kind of market we're in at this moment. It's not your normal conventional wisdom, you know what I mean? And that's, I think, for a lot of people, it's like, what? You know what I mean? People are used to, more QE, more liquidity, more support. It's less support for your currency. Your currency is going to suffer as a result. But we're seeing the opposite of that. So what do you guys think, Stelio, Steve, about that idea?
I personally think that the idea theoretically is right, but what we saw today is the euro strengthening, but it's not because the euro is stronger, the euro dollar went up. I think it's because we saw a little bit of risk on immediately after the announcement. Stocks were down, 0.5%, they went to flat. And I think the fact was that the dollar was depreciating, as we've seen this relationship, stocks higher, dollar lower. And that's why I think euro dollar was rising. But having said that, it's coming back now. So I'm not convinced. If you put a gun to my head and tell me to trade the euro dollar for the next day or two, I'll probably buy it still, but I'm not sure now. I'm really not.
Yeah, and at these levels, I mean, look, I'll just, I've got a 4-hour chart here of the euro. We just hit the 127% fib of the most recent, sell-off. That would be the March 27th highs to the lows that were in April. Hit the 127% extension, hit a new high in price, relative strength didn't. So, this warns me that I think we can see a move back down to 111.50, and I'd rather be a buyer down here versus these levels. And if you think about why that might happen, well, if the euro does actually pull back from current levels, it's probably more of a function of risk aversion versus anything else, right? Just as you were saying.
Yeah.
Yeah. So, Steve, what do you think with the way the euro is reacting this morning?
I think it's normal under these abnormal circumstances and under this abnormal environment that economic wisdom has not only gone out of the window, but more or less reversed. Now, it makes a little bit more sense in the case of the euro because understandably, one of the things that weigh down on the euro is the fears that have been there since 12 years ago, roughly, a little bit less, 10 years ago, that at some point the Eurozone might break down. So I think that what mostly affects positively the euro when we see stimulus is that in essence, most of the stimulus is a wealth transfer between the wealthier nations of the Eurozone to the least wealthy nations. And that should help in decreasing any tensions or any tendencies for breaking down the Eurozone. So in that sense, it makes sense.
Yeah. Okay. Well, there you go. Well, it's good to hear your views, and I think that the more, like as you pointed out, the fact, and there's actually I was reading a Goldman piece yesterday, Goldman Sachs piece. One of the 5 things that they said solidifies the recent rally in the euro dollar is basically it's looking more and more like a union. So the threat of breaking up is not as great right now. So that's obviously going to continue to help the euro. But anyway, I'm going to pass it over to you guys. Guys and gals, if you haven't tried out ForexAnalytix, make sure you do so. But more importantly, if you haven't selected a broker or you're not happy with your current broker, visit Forest Park FX. Forest Park FX actually helps manage our reimbursement program. If you want to, take advantage of ForexAnalytix for free, you could do that through your trading, or if you are in the US or Canada and you want a cashback rebate, you could select that program as well.
1.9 million initial jobless claims. Sorry to interrupt, Blake, but we have important data.
Oh yeah, sorry, we have economic data.
Minus 49.4 billion of trade deficit. Continued jobless claims a lot higher than expected, 21.5 million. And Canadian trade balance worse than expected, minus 3.25 versus minus 2.36. US labor cost revised to 5.1 versus 5 expected, and productivity, US productivity revised, higher than expected, minus 0.9 versus minus 2.7. So labor data worse than expected, the rest somewhat better.
All right, very good. Well, hey, I'm gonna let you guys go, but remember, if you're looking for a FX broker, Forest Park FX will help you out. I'm gonna pass it over to you guys. I got to go listen to Christine Lagarde right now. I'm gonna go listen to maybe you can hear, she's speaking right now, so I got to listen to this thing. All right, guys.
Hey, have a good one, Blake.
As much as I'd love to listen to you guys, have a great one.
Thanks.
Bye bye.
See you guys.
Hey, Steve. Hey, Dale. How you doing?
Hey, Stel, how are you?
Coach, how you doing, my friend?
Good, buddy.
Good.
Hello, guys, and
Hey,
everybody else.
Steve.
So the ECB is making another move. They're throwing more money. They said, just like Blake said, they're increasing by 600 billion. They're going to extend the purchase program to, as they say, at least June 2021, and they will reinvest the holdings.
I'll once again take the over in that.
Yes. They will reinvest the holdings, the PEP holdings, until at least end of 2022. So theoretically, all this should be bullish risk. The market thought so initially. Now it's coming back.
Finally, time for the market to price in something positive. I mean,
yeah, exactly.
It's been suffering so much lately from pricing all the negative stuff.
Yeah. I don't know what the catalyst is going to be. We've been saying this. I think there will be a catalyst which will send things a little bit lower. I don't think we're going to see a crash, but I think a healthy leg lower is coming, and I'm waiting for that. Now, the US jobless claims, for people who are not, actually, not for people who are not familiar, but this number is going to ease off eventually. It's still in the nearly 2 million per week. But remember, the US population is 350 million. The workforce population is just over 200 million, and we've lost over 40 million within 2.5 months. So this thing, just because there's a finite number of people who can actually work, will go down to zero eventually, or close to the usual numbers. But for me, the problem is that this has been going on for quite a while. It's been extended. We were expecting this because of the shutdown and the lockdown, and the associated, people have got fired, and losing the jobs, and corporations and small businesses have gone bust. So it makes sense. And it's continuing at a pretty horrible pace, if I'm honest. So, just something to remember. This number will go down eventually, but the question is how many jobs have been lost in the meantime.
I think the market might continue cheering until the data are very conclusive that, you can switch off an economy with a flip of a button, but you cannot return an economy to full strength with a flip of another button.
Yes.
It's as simple as that.
Absolutely.
I mean, there is a lot of support, and they've. I'm not going to use the word help, because they're definitely, what they're doing is destructive in the long term. But they've definitely alleviated a lot of the problems that would have been created. A lot more companies would have gone bankrupt and everything else, which is a clearing mechanism for the market to balance out and take the bad weeds out, and the good companies will always survive, and through competition you get a better market.
Yeah.
But they don't want that to happen, so they've managed to push back in time bankruptcies and big headline things, because we know what happened the previous time. they quote unquote made the mistake of letting Lehman go bankrupt, which, if you ask me, it was the only correct thing they did during the 2008 recession. But then they realized that that has repercussions, because you have to take the short-term pain in order to have the long-term gain. And in this case, they were prepared, very well prepared, as it seems, to make sure that they rescue everybody. And so far they've done that.
My personal view is the government should interfere as little as possible. Obviously, it's not nice when companies go under, but I have a friend who has a company here in Greece. They make wooden floors and stuff like that, and he's been very, very cautious over the past decade or so. And now
so he's a sucker.
Well, no, he had cash in hand to be able to withstand this shock, and now he's doing really well because many of his competitors have closed down. And he's doing even better than before.
But equivalently, in the US, for example, what the government is trying to do, and in many other countries, is in essence not let the bad competitors go out of business. Well, so in essence, the prudent company is not being rewarded for being prudent.
That's why I think this is wrong.
Penalized.
Next time round, what are they going to do? They're going to take more risk and be even more.
They're going to be more leveraged. Nobody's going to have money on the side.
For me,
so even more are going to need a bailout.
Yes.
Anyhow.
Yeah. Other than that, we had very little today. Some data out of the UK, construction PMI marginally worse than expected. Still in the high 20s, which is really not good, but it's to be expected. Aussie retail sales minus 17.7% month on month. Pretty bad number, but again, was expected. So nothing out of the ordinary compared to expectations. Did you see the Canadian trade balance number? That was huge. 3.25 billion against just the 2.5 expected.
Yeah.
And minus 1.5 last reading. So it's
there were times in the past that these numbers really mattered, as they should. Nowadays, they barely, make a dent in what is happening. Speaking of the USD CAD, though, Stelio, yesterday we mentioned that it's, it has approached, perhaps a key area of support, and so far the reaction today looks like the 200 daily moving average might actually do the trick here. So, it's a good start. Let's see how it continues, and let's see if actually this. This was a buy the rumor, sell the news, having to do with, the ECB throwing more money at the market, because we saw that initial spike higher, almost to test that 113 area, actually to test the bottom side of that 113 area. So I'm wondering if perhaps, the ECB event today will prove to be, a turning point, at least in the short term. Might be the case.
Yeah, could be.
We might have to throw our charts away for a few minutes tomorrow morning. What do you think?
What do you mean tomorrow morning?
With the NFP.
Oh, yeah. I mean, yeah. Likely it's going to be volatile, although in a magical way, the market seems to have completely, the numbers have been so bad and the stimulus so much that the market is just like it has decided that numbers don't matter anymore. As market participants have more or less in unison decided that deficits and debt doesn't matter anymore, which of course is a very, very bad miscalculation. And once they start mattering again, it's going to be in a very emphatic way. But for the time being, the market lives in this alternate reality that these things don't matter. So I wouldn't be that much surprised to see a horrific number tomorrow again, and the market not reacting that much. But we'll find out.
Yeah, I'm curious, Steve. I know that Grega and you and many people were looking for one more wave up in the bond market, and yesterday's action, does that put that scenario, make it look less likely?
Yeah, I mean, we broke through some very tight triangles to the downside in the vast majority of the, especially in the treasuries. I was showing the other day this chart. Here it is. And this is the little breakdown. Here's the 10-year yields. So
They look like
yeah,
they're turning.
yeah, they might
I mean,
be, but
everything could change tomorrow, but look, I know because I've been, I stopped talking about it because it became an EKG of a guy in a coma.
yeah, it was an EKG indeed of a guy in a coma. That was the
So,
case.
I didn't want to bum people out, but yesterday it looks like we came out of the range to the downside, and
So far, that's how it looks like.
we'll know tomorrow after the number if they can't rally it.
I'm very skeptical for two reasons. One, because this is barely a market anymore, meaning
Yeah,
I
know.
think the number of participants that are actually buying and selling here are very limited.
It's
We
nationalized.
Yeah, it's been nationalized at least at a very big extent, not totally, but at a very big extent. So I've in essence lost much of my interest here. I do think that the bonds at some point are going to suffer immensely. So my long-term thesis about the bonds is that they're going to be destroyed, because in essence, what are, for example, treasury bonds? They are a claim to get dollars at some point in the future. So I think that once the dollar starts plunging, treasuries are going to start looking like a very, very bad investment, which I think they are. In looking at the long term,
Is
I
the
think they are.
bond still leading the way with more pressure on rates to the upside than the U.S.?
The bond definitely has been showing more weakness, as we've said.
Yeah.
Now,
Okay.
during the past couple of days, I wouldn't say I see much of a divergence, but in general, the structure in the bond is totally different with what we've seen lately with the treasuries. There's no question about it.
Guess they're going to lead both ways. They led to historic lows, and now they may be leading for a bump in yields.
ECB cuts 2020 GDP forecast to minus 8.7%. Huh. That's quite interesting. And we're talking about the annual one, right? We're not talking about a quarter. So their forecast is a minus 8.7% for the year. So that tells you quite a lot. Stelio, by the way, if we have any statements from Lagarde that are, really worth listening to, just, interrupt and let us know. So the euro has bumped its head. Quite a few things are moving. The euro has bumped its head. This is what we drew several days ago. The euro has bumped its head earlier today at that spike that we saw to this horizontal support resistance area. So far, it seems to be holding. Blake mentioned it before that he would prefer to buy the euro at 111.50, and I agree that if you want to buy it at the pullback. I'm not sure that 111.50, if this is the beginning of a pullback, is going to be enough because it's rather close. I wouldn't be surprised to see a dip even back to 110, which was the breakout area of this rectangle before the Euro USD moves higher, if indeed this 113 area produces a rejection, which I think it's a decent scenario. Inflation this year from ECB, I just have the squawk in my head. The ECB sees inflation for this year at 0.3 and next year at 0.8%. Now, we had a question from our friend Dimitris asking about what I think about the USD Swiss. I'll refer once again necessarily to the Euro Swiss because the Euro Swiss has broken out. The problem with the USD Swiss is that the USD Swiss had a beautiful triangle and it has broken through it, but it finds it quite hard in producing a continuation from these lows there. And the reason is this, the Euro Swiss, because at the same time that the Euro USD is breaking higher, we have the Euro Swiss breaking higher as well, which in essence limits a lot the potential for downside for the USD Swiss. So, as I said in advance, when we saw the initial move higher from this descending channel here in the Euro Swiss, I said that, listen, if you're looking to buy the euro and not sell the USD Swiss, that remains my opinion here. Meaning, as long as you want to be long the Euro USD, just be long the Euro USD and don't be short the USD Swiss. Now, if you're looking to be short the Euro USD, due to what the Euro Swiss is doing, perhaps it's a better idea to be long the USD Swiss. So, depends on which side you want to trade the market, having to do with the dollar. Choose one or the other based on the fact that Euro Swiss is breaking higher, meaning Swiss weakness is spilling over to the USD Swiss. Okay. So, more news coming through, but nothing worth, transferring. So, I mentioned yesterday the USD CAD saying that the risk reward has switched from, favoring being short to favoring being long. And as I showed before, I like this initial reaction from this confluence of supports. So keep that in mind. I wouldn't be surprised if USD CAD turned higher from here. And although I'm still short both the Euro NOK and the USD NOK, I have to also admit that USD NOK is also testing a confluence of supports here. So I also think that the downside potential in USD NOK makes no sense anymore from a risk reward perspective. I mean, you can contemplate into selling it once it produces a rebound. I'm not saying that it will necessarily produce a rebound, but what I'm saying is that selling here, if you had no position so far, I think it's quite a dangerous proposition. Because as the USD CAD has found the confluence of supports, the same thing has happened with the USD NOK. So I do think that probably this is a good area to try to fade, even for a short-term trade, this weakness. Personally, even if I wasn't short, I think it would be even better to try to sell, if we do indeed get some type of rebound from here. Now, Euro Yen, I mentioned yesterday, and that's what we drew here, or it was the day before yesterday, one of the two, that, we've produced a clean breakout from this confluence of resistances at 119.60, but we've now reached the previous highs there, and that might actually act as resistance, producing perhaps a pullback to the breakout area, which would most likely be a very nice buying opportunity. So far this area seems indeed to be rejecting price action. Now what is left, some type of confirmation. I think a retest of 119.50 to 120 is probably going to be a nice buying opportunity, because in the short-term buying, this move is already, quite impressive, from 114.40 all the way to almost 123. I think that, trying to buy after such a move is kind of foolish, and there's definitely no risk reward. I would want to see a retest. I think that would be an excellent buying opportunity. Let's see if the market is going to produce such a buying opportunity. We're going to find out soon. Now, let me go through some of your questions, because yesterday we didn't have time to answer any of those. Oh, speaking of the metals, by the way, because every day we have people asking about them, and crude, by the way. So let me start from crude. Crude still appreciating within this ascending channel, has now reached from deeply oversold territory to overbought territory in the RSI. We've gotten close to this 127% extension, also horizontal support resistance area. Clearly, the risk reward does not favor anymore being long. It did until very recently, but I do think that, a pullback here as well is warranted. The shallowest one I would consider would be back down to $29, and I remind you, this is the continues. So we're talking about, prices in the continues, right? I do think we've seen the low. So levels to be buying it again, 29, 25.70, and $20. I think buying a decent dip is probably a very good opportunity. Now, having to do with indices, not much to say. The only reason I'm mentioning them again is because we've now reached my ultimate target in this potential rebound, which was the confluence of the 78.6% FIB in the S&P and this horizontal support resistance area. I'm still short now. I've built a full position, and I'm still looking for a pullback towards 2,700. So, nothing has really changed in that. Nasdaq yesterday actually almost touched the all-time highs. I'm still viewing this though as a potential ascending wedge, and the implications would be a revisit of the beginning of this wedge at 8,350. Implications of breaking down from it, right? Because we still haven't done that. Now, I don't know if the catalyst can prove to be the NFPs tomorrow. So far, the market hasn't really been reacting to the horrific numbers. But, sometimes the market doesn't react until it reacts. Dale, strategy help you become profitable, and where did you learn it? Asked by Diosthenis. I don't know if you want to answer that, Dale. What strategy helped you become profitable?
Answered it.
Oh,
I
you
answered
did?
it, Steve.
Okay.
Yeah, I said I went to the University of Hard Knocks and got a degree in survival.
Ciao, Steve. Have we seen the high in Euro USD? Asks Gregorio. I very much doubt it. Depends on the time horizon you're asking. So if you're asking me if we've seen a short-term high, might be the case. If you're asking me if we're going to new lows from here, I seriously doubt this. Very seriously doubt it. If the ECB is bullish, Chris, are you bullish the 10-year yields? Listen, perversely, the market still, for the reasons we mentioned before, considers more easing as positive for the Eurozone in total. And, as long as you have a positive risk reaction, you should expect that the yields should not strengthen. If we're talking about benchmark yields, because let me make them, there is a big difference here. So depends on if we're talking about, for example, the German yields, which are considered like, the benchmark for, safe haven, in which case anything that is considered a positive development should help the Bund yields ease off. Or if we're talking about, for example, peripheral yields, because, for example, if we're talking about the yields of countries like Spain, Greece, Portugal, Italy, then you should expect any positive developments having to do with the Eurozone to strengthen those bonds, so make those yields drop, because the market considers then the risk to owning the debt of those countries to be decreasing substantially. So in this case, you should expect the bonds to move the opposite way than peripheral yields. Okay. Since you didn't make the question specific, I had to differentiate between the two. Guys, what's your take on gold? What's our take in gold? Short term, we might see a deeper correction. Once again, though, I have to stress it out here. I've said many times that this 1690 area, you can see here, this support resistance area, is designated as the first, in essence, support that we have since we crossed over it. Once again, it held yesterday, and we're seeing a reaction today. Now, there is clearly, there are clearly several divergences we can notice in gold. Silver also pulled back, quite hard after reaching that upside target, roughly reaching that upside target. So I wouldn't be surprised to see a deeper pullback. But as I was saying yesterday, once again, because I've said that many times since months ago, monetary metals are currently at the best environment somebody could find for them. So bottom line, in my opinion, looking to short is probably the bad proposition here. The best proposition is whenever you see that from a technical perspective, they're overdone and they're likely to pull back. This is probably one of these occasions. I think it's better to just let them do that and buy them than try to short them. Because under this environment, we've seen gold and silver produce some outstanding moves on a daily basis on occasion, and you don't really want to be on the wrong side of that market when that happens. So, I gave you both a short-term and a longer-term outlook. Longer-term outlook, it's very hard for them to really move much lower. I mean, they can, of course, produce some deeper pullbacks, but, not easy for them to not perform well over time. Numbers just don't matter, everything is bullish. Yeah, for the time being, that's how the market reacts. Gold is correcting, should have some buying opportunities down the way. Yeah, I totally agree with that. US equity may be thin market, not driven by fundamentals, more speculation on IT stock. Bank stock seems more realistic. Yeah, but banks, it's not, bank stocks act more realistically because the central planning of monetary policy has really completely destroyed the traditional banking model for profitability. That's why. So the traditional model of making money as a bank is dead either way. Dead either way because as long as this monetary insanity is in essence controlling markets and the yield curve is flat and doing nothing, the banks can't make money in the traditional way. And after having done that for so many years, even if they decide one day, even if they realize one day that what they're doing is destructive for the economy in the long term and is a big part of what's wrong with the economy, the economies, or the global economy, if you wish, even if they, let's say, decide to stop doing it, the problem is going to be, so big. It's already so big. It's like, it's like a tooth that starts getting, I don't remember the English word for that. Decay, yes. If you catch it early on,
it's like options. They have decay.
Yeah, I mean, exactly. If you catch it early on, you go to the dentist, he takes the upper layer off, then puts a sealing on, that's it. But if you let the problem, go deep in the tooth, you lost it. That's
root
it.
canal.
Yeah, a root canal, exactly. You lost
Which
it.
is what some people say, listening to my analysis, is like going through a root canal.
Yeah, so same deal. If they decide to do the right thing so late, what's going to happen is that the banks are doomed once again because so many loans that they've made to so many companies that are zombie companies are just going to go bankrupt.
So they lose a tooth, but the Fed does implants.
Yeah, that's one way of saying
I mean,
that.
you started it, this dental metaphor. I could keep going with it.
Yeah, I know you can. I know you can.
All right, anyway. Wrap it up.
Yeah.
In a couple minutes.
Lol, Dale's success is based upon not taking my advice.
Yeah. He's a good friend and contrarian indicator.
He is. Let me see. I want to know. Okay, a lot of questions about gold, Aussie yen, euro, Aussie. Yeah, actually, I'm gonna wrap it up by very, very fast going through that because my eye caught yesterday. We had questions about these crosses, meaning euro, Aussie, euro, kiwi, etc. What I'm gonna tell you about these is, first of all, euro, Aussie. Back tested today this horizontal support area and look, yesterday I meant, look at this candle. Yesterday's candle is quite interesting. It's a nice hammer. Definitely a prolonged move lower, but I do think it's bound for some kind of rebound. So I think in the short term, Euro Aussie might not be a smart idea being short anymore. At least it should produce some type of a reaction rather soon. Euro Kiwi found support yesterday and is reacting today again at this confluence of supports that includes the 200 daily moving average. So same deal here. Be a little bit careful. We've already seen a decent move to the downside. So at least, I wanted to cover those. So Dale, interview time.
Yes, it is. Yes, it is. Okay, so Henrik Zeberg, I'm going to set you up now, Henrik.
Set him up, set him up.
And Steve, you'll have to stop sharing your screen in a minute.
Absolutely.
So
there you go.
Okay. Welcome back to Face, Henrik. You could unmute. There's a drop down.
There's an unmute there, right there. Thanks. Thank you, Dale.
Okay, you're a little low. Can you bring up the volume a little bit, buddy?
Oh, yeah. Can you hear me now?
Better, yes.
Better. Okay, I'll speak up loud then.
Okay, so there is a screen share. It's on the drop down menu. Have you used Zoom before?
Yes, I have.
Yeah, who hasn't since the pandemic? And I don't know about you, Henrik, but I'm trading this pandemic a little better than the last one.
Oh, you did? It's good. Good to hear.
All right. Well, my trading warrior brother, welcome back to Face.
Thank you.
It's been a while. And, you always bring a nice PowerPoint presentation. I'd like to acknowledge that your, economic winter and deflationary narrative was spot on in energy. I don't even think at the time you were looking for negative 38.
No, I wasn't.
We've had a blow off to the upside in the bonds where, yields went to historic lows. That was part of it. And how have you felt over the last year or so about, I know when I have a bias, I'm always looking for reasons technically to put on the trade. And when I'm the wrong way in the trend, sometimes I could make money if I manage it right, counter trend. But overall, it's difficult. Why don't you tell us how you've been, because, the whole FinTwit universe knows your view on gold. What's it been like for you to have watched us rally $500-600 and not, first of all, the opportunity cost of not being long for a move like that, but probably trying to top pick it along the way up?
Yep, that's fair question.
Okay.
Well, it's been tiresome, I would have to say. It has been interesting to see that we did see an extension of this sideways movement. It's most visible if we go to oil, and actually, if we look for all 2019, actually we go back to 2018. I did see the top, and that we're going to go much lower. I didn't. Sorry, I need some water here. Got some.
Okay. Leave all the time you need.
Thanks. So it was in 2018 that I saw that we were going to go a lot lower in oil due to the structures that I see in Elliott waves. Did I see 2019 become a long, tiresome walk sideways? No, I did not. But still, that doesn't change the structure, and that didn't change the fact that we were going to below 20, which I saw in 2018. Right. And actually later I said on FinTwit, I've been saying below 10, and we surely got there.
And I saw that.
Yeah, and at the same time, we'll have to ask ourselves, so what happened then? Because was that really the end of it, or was something more coming? And everybody seems to think, well, that was it. We are all done, and it's that was the deflationary part. My charts tell us that we are not done, and we are not done with the deflationary part. I'm actually going to see. I see that we're going to see a much bigger bust in inflation levels, and hence going to go we're going to go through a severe deflation. And I know everybody will saying again that we have the Fed all in and gone nuclear and all this, but they have done this before and still not been able to go up against the tornado of a deflation. So I think my chart at least tells me we are going to go lower.
Okay, so is it possible last time the Fed embarked on this in the Great Recession, they really held the whole thing together for 11, 12 years. This time it's been more massive, but since we are in an economic winter, is it possible that this time maybe the Fed bought us 2 years with what they've done?
That's a good question. That is definitely a good question. And that could be. I mean, there's nothing, and especially with having seen 2019, which was a long, still in a downturn, but a long sideways move. Could we then see, this same thing? That is something we could consider. I think there are signs which are showing us that it could come much before that. And there is an end to everything. And if we look at it if we look to some of the models that I can present here, I think that the deflationary bust will be within the next 6 months. But
okay.
Can I be wrong? Yes, I can, of course. But
okay.
but if maybe I can dive into it.
Go ahead, buddy.
Right.
I appreciate you fielding the questions, and look, I know how it can be on Twitter and some of these other sites, and you know what? Everybody's wrong one time or another. Forecasts work, and forecasts. I thought it was going to rain, and the sun came out today. So
exactly, yeah.
It's how you manage it.
I'm not. Yeah, exactly. And I was long with the skull you're referring to from the 1350-60 to until 1500. So I mean, I got my small share. But anyway, but if we're looking at it from a macroeconomic point of view, I mean, I see.
I know. That's a great shot, Henrik. Because I was just saying, this is like the invisible depression because people didn't have cars in the 30s.
No, and I think it's going to become much more visible. I think we are in the early stages, and I think that we had a shot across the above with the what we saw here earlier this year, but it's definitely not the end of it. That goes. Okay, let's go on. What I see still is that the contractive winter, which I still, this is where I get the understanding of where to position myself. Are we out of the winter? Well, no, I don't think we are. I think there are still some, events that we're going to see coming. And we're going to see, for instance, the pension fund crisis. We're going to see the run from paper money to gold. We're not seeing that yet, despite me being wrong on gold for some time. I haven't given up on my target. It is still we're not there where the real run, the run from fiat currencies is kicking in. And one thing we have definitely not seen, and that's the debt at record low levels by the end of the winter. So we are not at the end of the winter yet. And then we have war, which I hope we'll never see, of course. So I think we're going to see a replay of a lot of the things that we saw in 2008, 2009. And then we're going to see some new ones coming, because that actually shows us how desperate the different central banks have become in trying to solve this in a monetary way. But that goes that's because they missed the big picture, as I see it. And the big picture is that debt is the reason why we are in the winter. Debt is the reason why we cannot see growth. Debt is the reason why we have deflationary pressure all over the place. And they are trying to handle that with monetary stimulus, but even monetary stimulus would at some point come to will get challenged, even in a world where we have debt. So
by who, Henrik? Are there bomb vigilantes still out there in hiding that will be resurrected?
Well, I think we could see inflation bottom at a point where we do not want it to see it it bottoming. Meaning that we're going to see a stagflationary period. We're not there yet, and I think we're going to see one more bust in the deflationary period. But just to come to my point here on this slide is that by the end of contractive winter, we will have to see that the debt has been brought down to a record low level, to a low level, What we have seen since 2008 and 2009 is that it's been going up ever since. So have they solved it magically this time around by bringing a lot, debt into the system, by printing money, which actually by the end of the day brings more deflationary pressure as it brings up, it builds debt? I don't think so. I think we are going to go the full cycle, and we might see bounces and jumps, here and there on the way, but we are going to go full cycle. So, and also, if we look at the economy, it is plummeting. I mean, I know there's a financial market, but if you look to the real market, to the real economy, that's where it unfortunately hurts right now all over the place. So we have auto sales, which is a good leading indicator, plummeting and really fast. We have the Chicago Fed National Activity Index, which fell 22.3 standard deviations. I mean, this is out of this world. And this
How do you explain the disconnect between the real economy and the equity market to people?
Money printing.
Okay, that's what I thought. All right.
And money printing, of course, is that going to rule and going to be the one standing by the end of the day as the victor? I don't think so. I think we're going to go full cycle deflationary wise, and then also stagflationary wise. Okay. I think I look at makes it it consists of eight. I'm breaking up.
Now you're better.
Okay, better now?
Yeah.
Okay. So what I see is that with an index like this falling 22 standard deviations, of course, it's something that's going to not just last for a few weeks and months, and then we're going to see the Fed, magically going to be able to transform and change the whole direction of the economy. The economy is a super tanker, and it's going down right now. And at this point, is actually Titanic as I see it. So. If we look to copper, as the way I look at it, I think we have a long way down. And copper, to me, is that an indicator of the real economy. It's an indicator of where we're going in terms of employment and GDP. And for the way I look at it, we have been bouncing since March, but it's only a bounce. And in my Elliott Wave world, we're going much lower. We're going below
82.
the level of. Yeah, 82, something like that, back to 2003 levels.
I'm so old I could remember prices down there.
Okay.
50 cent, 60 cent copper if you look left. Anyway.
Yeah.
Okay, go ahead, buddy.
But that is the indicator of the real economy. So, bounces along the way, yes, sure. But I think actually the next decline is going to get much tougher. And that's going to be
Dr. Copper contracted COVID.
Well, yes, we can say that. I think actually COVID was the trigger, not the reason for.
Right.
I think the bubble was there. The bubble was there to burst at some point, but COVID was the one that made it burst. So
yeah.
And okay, sorry.
Go ahead.
No, and then of course unemployment. I think it's going to take years before we come back down. I just want to put this in. I mean, when we have something like the unemployment jumping up to above 15 at this point, this is not something that's going to be solved by money printing. If that was so simple, Weimar Republic and Zimbabwe would probably have had better faith.
Good point.
So I think it is. There is a disconnect between the financial market and the real economy, and this is what we see, of course, in equities. So here we have the S&P futures. I think we are close on some kind of top here. I know that the mark count to suggest that there could be a top in here. The Elliott Wave definitely tells us that we could have an A and a B and a C, which will take us down to, if A and C are equal length, down to the level from 2016, which is the bottom of wave 4. That is that's my main scenario. If we break above 3150 area and with strength, again, we could see the disconnect come, entirely and supreme, and by seeing all new all-time highs. But that would only talk to the severity of the next deflationary bust, because a complete disconnect forever and ever in the real economy and the financial market is not going to be. It's going to last for some time, but not forever. So we are going to come down at some point in a deflationary manner, and then we're going to see stagflation at a later point. Is it going to work with this kind of timing I put in here? Probably not, but we're going to see both deflation and stagflation before we are by the end of Quadrature's winter.
Okay.
And then, so yeah, stock hikes and in extreme bubble. I'm just taking some very good tweets here from Andrea Costa on Twitter and say, looking at the Schiller PE ratio, which is an extreme, showing extreme bubble. We have Sven Heinrich here pointing to the 143 market cap to GDP. So are we? I'm not, worried one bit to say, well, we are in a bubble scenario. We are in a disconnect between the financial and the real economy. And if we look at the at what we have ahead, this is from Andrea Steno and on Twitter also. If we look at the U.S. Velocity of money, and this is really the key of driver of inflation, that is how fast is money circulating, and how does that then impact on the CPI? And if you look at it here, it seems like we could see a major drop in CPI, which would go hand in hand with what I expect in deflation ahead. So I think we are going to see. So if I look to some of the to commodities, this is a very similar pattern to what we had in oil back in 2019-18, that we see a descending kind of triangle, and we're going to see another leg lower to a secular bottom coming later this year or maybe next year. So we are not out of the deflationary, and we can show other charts like that. We have also with corn. I mean, that small bounce in 2020, should that be the bottom? I don't think so. I think we're going with with the
$1.80, $1.80, $1.50.
Go lower there.
Yeah. Okay. Interesting that you like agriculturals, because my old expression, you can't eat gold.
Yeah, but I will bring that up a little later. But it is about it shows us something about are we inflating the world? Or are we deflating the world in the world right now? So I'm seeing deflation, and also my favorite inflation gauge, the Aussie dollar, suggests what I see is a very strong deflationary phase. This bounce that we see from March again, which we see in everything from copper and everywhere we look.
The market's completely binary. They've all recovered, just a difference of magnitude.
Yeah, and so what I see it as a bounce. It's not the bottom. It is the.
Where would you say you're wrong in Aussie, that it's more than a bounce? Closing above that channel? How much tolerance above the channel?
Yeah, well, I could see another pattern playing out as well, but that would be in the world that you were talking about earlier. So if they bought us another 2 years or so,
okay.
Then we could see another pattern, but that again, we have to bring all the charts in alignment, and this one is cannot stand alone. Euro dollar, I can hear about the excitement about this the small bounce we have seen in euro. I'm not too positive about it. I think it's just what we can see here is another test of this area. And in fact, if we I think I have another short-term chart here. If I look at this. What we since March, in my world, there's no doubt this is a correctional pattern, all in yellow, and that means that all correctional patterns will be reversed and you'll surpassed. So the bottom back in March will easily be surpassed. So this is correctional pattern, and we actually just today got into the area where we have the first strong leg A equals C, meaning we could turn here, or we could turn a little higher. But but the strong coming decline could be quite strong. I might just jump to my euro chart here for a sec, my longer term, and to me, there's no doubt about it. This major pattern we have in euro is not complete.
Yeah, but it could go 114. Is that why you're showing the B up there?
Yeah, I think 113, 14, yes, something around here. We could go somewhere. It's more than when you zoom in here. So I could see it go higher, but it's not. Again, euro strength would suggest that the world was all clear. So the dollar is not going to be the wrecking ball anymore, and we can get back to growth, and emerging markets will be all fine. Right. I don't think we are there, because that's not what we see when we see the deflationary indicators. Okay. So, and then we're coming to some of the precious metals. We have. I like to make this pointer to all the gold people, to the gold bulls. If gold bottomed in 2015 and silver then bottomed in 2020, I mean, Was it like normally we would see silver leading gold, and this it just seemed that silver was 5 years late this time. I don't think that's what we're seeing. I think what we're seeing is, again, what we talked about, the sideways movement, and we have not seen silver nowhere near the top of what we had in 2011. So in Elliott wave terms, this is something that needs to finalize lower, and the kind of move that we see in the short-term time frame here is simply a double zigzag, which is going to bring us down in a very strong leg down lower in a C wave of this Y and then the big C.
Sub 10.
Around bottom 2008, yes.
Yeah. I mean price wise, sub $10.
Sub $10, yeah. And
okay.
I meant yes, from the time
Okay.
back then. And then we have gold, of course. You know, so again, this was the kind of, if I can just go back to silver here, this was the kind of movement that I was expecting in gold when we talked the last time, Dale.
Yeah.
So silver and gold normally follows, you know, along. And this world here, it went lower, and now it's been bouncing up, but it'll come lower as I see it. But
yeah, because the ratio went to gold-silver ratio went to what, 120, 126,
yeah,
and recently pulled back to 95.
And if we look to silver, and we look to all inflation indicators, and we look to miners, and we look to everything, the one and only that stands out is gold. So either gold is wrong, or the rest of them are wrong, or it has simply just disconnected. I don't believe in the disconnect. You'll not see a disconnect between silver and gold. So, so I think it's about the kind of structure that we have in gold, which was not the triangle that I suggested last time, but it's just another one. And that is also why we have not seen, if it was the case that gold was going to, you know, extremes, and we know that the Fed is already in with, you know, everything. Why haven't we seen all-time highs yet? And why are we seeing this kind on the weekly of very strong divergence, 10 months worth of divergence on RSI, stronger even on 5 months, and this kind of wedge which we are breaking out from. So I'm sticking to the point that no, it was not the triangle that I talked about last time. This is a double zigzag, but that's just another Elliott wave pattern. But that doesn't tell us that we're going to all-time highs from here. That tells us that we're going to go a lot lower, and we're going to surpass that point because this is a correction. And if we look at this, this is not a bull market takeoff. So I will be saying again the same thing. My target has not changed. I think we're going to 890 on gold, and I think we are getting closer.
890, you said?
Yeah, 890. Yes, around there.
Okay, you know why that number rings a bell to me?
No,
that was a high in 1980 when Russia invaded Afghanistan, and we had $50 silver.
Yeah.
And 880 was the high of the previous gold bull market in the 70s.
Wasn't it just below 890?
880, I remember it.
880, yeah, so, something like this. Yeah.
Something right in there.
Yeah, exactly. Yes.
So it's a retrace back to the bull market of the 70s.
I could have shown you that chart, but that actually also makes sense in the bigger structural perspective.
Okay.
You're absolutely right. So
interesting number. Okay.
But this kind of structure, if we look at this again, you have to look at, you know, with something that starts out correctional, does not all of a sudden become a bullish move. Yes, it's bullish and it's a strong move. You know, make no doubt about that. And from this point, I know going up here, this is a great rally. So no doubt about that. But that does not mean that this is the right time, for instance, which is my strategy, to buy miners, because the miners are going to go a lot lower when this is going to happen, as I see it. So let's see how this plays out. We could, did they buy us 2 years? This does not suggest that we are going to see another 2 years of rally. So my forecast on the 6 months, 0 to 6 months, is more deflation, illiquid kind of environment. We'll see if oil comes down again hard. I'm not sure we've seen the bottom of it, even at those negative levels. We still see more US dollar shortage. We have an extreme of that. We have a bounce for now, but we're going to see it play out again as I see it. USD dollar will go up. Equity sell-off as I see it. Unemployment, GDP crash, all the bad things, but of course, massive intervention. But I think we'll have to get to the more fiscal part of intervention before we will see something which is coming, which will be inflationary. And we are getting closer to the inflationary scenario, which was the secular bottom I pointed out, if you could remember the corn and the wheat charts.
Yeah.
There are a secular bottom coming in, which means that the whole economic regime that we have right now, which is deflationary, is going to change. And that was the point I talked about when you asked me if there will be a point of where the stimulus will no longer work. That's the point. Because in a world where inflation starts to rise, but you cannot bring down unemployment, that's when you cannot do stimulus anymore. That's when you'll see inflation coming out. So, and that I think is that I think is what we're going to see from 6 to 36 months from now on. Stagflation, some of these bad things happening, and that's also going to be a terrible equity environment. This is going to be the phase where we will see the real gold, silver, and Bitcoin bull market. And then I see for the longer time frame, which will be the contractive spring, which is where we have brought down the debt levels to record lows again, because we need to see the inflation bring them down. We need to see insolvencies or bankruptcies and debt forgiveness and what have we before we get to that, and maybe some kind of new monetary system, which I could also be envisioning. But
what's your guess for a new world currency? SDRs?
Well, yeah, could be. I haven't put much thought into that yet, but it could be some kind of basket. I think there probably is a reason why the central banks right now are buying gold, because they're all thinking, if we want to have a stake in that game when we get to it, it's about having as much gold, in our bank deposits in our deposits as we can. So, I think it's about going to be a basket of something, but I think it's going to be US dollar friendly. It's going to be something that the US dollar is going to strengthen. But that's a long story.
Yeah. Okay. All right. Well, anything you wanted to wrap it up with?
No, not so much. I mean, I continue to see this, bad things unfold. Unfortunately, I cannot see, it's not just about one chart. And I think that has been the strength of some of the good calls I actually had. There were the things on the CRB, on the Bitcoins, and there were others.
What's your view on Bitcoin? Is it going to deflate with deflation and with the market?
Yeah, I think yes, I think it is. If you don't.
Jane is asking if you have a view on Bitcoin.
Yeah, let me just see. Oh, can I get to it here? I got it somewhere here. I think there we got it. So. Don't put too much into this trend line here, but again, to me, it's about the structures. You got something here, you got something there, and then considering what are they? Are they, primary moves up, or are they correctional? This is a correctional move.
All right, we're not seeing that chart. You might have to just
stop
your share and then reshare if it's on a different screen.
Okay. So let me just point it out in words instead. Okay. So I think we're going to see a strong decline from around these levels here, and then to around the 2,100 area before we're going to see extreme highs. During the run from fiat currencies, we're going to see Bitcoin be a place to seek some kind of safety. When the Fed probably gets in and trying to crash the dollar on purpose. So Bitcoin will be a place of safety at some point, but I don't think it will be here.
You have a view on COVID? Is there going to be a second wave that could add to deflationary pressure?
Actually, Dale, I think you put on the one the great chart there where we had was it the three waves that you were pointing out to during the pandemic and 1918 and 1919. I'm actually referring to that when I speak to people, and I think yes, of course it is going to, because it's going to put pressure on the velocity of money.
Who's going to go out between the virus and social unrest? Where do you go?
Exactly.
I haven't had a haircut in 4 months, buddy.
So how do you look now, Dave?
How do I look? I look like a refugee. Here you go. This is how I look.
Okay.
I look like Ringo Starr. I have a Ringo cap. Anyway.
Yeah.
Henrik, thanks for coming back and taking questions and owning things. This is a tough business, and you've laid out a pretty difficult time frame that we're in. But looks like if you could just get through the next 3 years, that there's hope on the other side if you manage yourself right and live in the right place, and you could be there for the beginning for spring.
Yeah,
The spring
exactly.
we didn't have this year
Exactly.
in the economy in 3 years.
Exactly.
That's something to
Right.
look forward to. So you get rich, and then you just buy the bottom of everything and sit on a beach.
We can hope for that.
All right,
So,
buddy. Anyway, thank you so much, Henry, for coming. It was great talking to you. Let's not let this much time lapse. And you're my trading warrior brother. I wish you all the best, and that you're on the right side of things, whatever you touch.
thank you, Jens, and same back to you.
All right, everyone.
Cheers.
So that's a wrap. Remember, don't just count your deflationary positions, count your blessings. And we'll be here tomorrow for the NFP. Trade it, react to the reaction with us tomorrow. Thanks again, Henrik Zeberg, and we'll see everyone tomorrow. Very welcome. You're welcome, Jugal, Darshan, Ite, Mode. See you guys tomorrow. And ladies. Adios.